Hello, everybody. This is John Blank, Zacks Chief Equity Strategist and Economist. Today, January the 3rd, I am putting out for later this week the 2022 strategy set, review of tech stocks, part 1. This is going to be an ongoing series for me. I'm going to do it twice a month. And we're going to go through various incredibly important issues in the stock market and use the Zacks research systems and Zacks advisor tools to show you the insights that you cannot find anywhere else about issues that are very, very compelling for stock investors and traders. So this is my first episode, like I said. The second episode, part 2, will come out later this month, and we will continue into the emerging tech stock area that is both bullish and bearish on 2022. So anyways, this is something you can look forward to. I hope you enjoy it. And this is something that will be found on YouTube through our channel. So off we go on my first set. All right, first off, we've got to go through the very broad spectrum of what happened in 2021. Number one, spider growth stocks, SPYG, did extremely well. They actually outperformed the SPAL, which was the market weight, S&P 500. So 27.4%, incredible year for large cap stocks in the United States. And if you were in just the growth area, 32.3%. So fantastic returns for the growth stocks. Value stocks, 21.95%. Not as strong, but certainly respectable. Now, this is where the story gets a little more complicated. Below, whether it's growth or value or the market weight, S&P 500, the story gets a little less compelling. The Russell 2000 started off great, through the Biden inaugural and into the early vaccination. And then it did nothing for a long, long time. Very volatile, too, for the entire year, all the way to the end of the year. And that made us give only a 13.75% return for the Russell, which, by the way, is a good return. It's an average return, but it's just not as strong, as compelling as the S&P 500. Now, outside the United States, generally speaking, it was a very poor year. And you can see this through the purple line, which is the iShares MSCI EFA ETF, ticker EFA. And it's gone sideways basically since May. So why is this the case? Well, basically, the outside of the United States just did not show any real luster to the stock market investors. So people stayed with the momentum trades in the United States. I set this up for you largely in a tech stock setting because spider growth is going to have those tech stocks. And that is what I'm focused on today, is why on earth the growth in tech stocks have this compelling story, what the landmines are, and what are the opportunities. We'll go through this for the next couple sessions. All right, so tech stocks. Look, tech stocks is broad language. We've looked into this at length over the last few weeks, and we incorporate at least 5 emerging areas in this environment. Obviously, this can change, but let's keep in mind these 5 areas of emerging technologies and their domains. Number 1, innovation. E-commerce and the Internet of Things obviously is a big, big part of innovation. Big data and artificial intelligence is kind of tied to that. And social media and cloud computing. This makes up one network of innovation on computing itself. So this is, it just started yesterday, but it's all been building through the chip stocks, particularly who allow big data and artificial intelligence, and through some of the big e-commerce sites like Shopify and Amazon. And of course, we're on social media, cloud computing, and things like this right now. So obviously those have been also very big. Google, Facebook are the classic examples. But there's many, many other companies below the radar to talk about in this area. Genomics, DNA technology, stem cells, bioinformatics, things we can learn from your genes that can happen to inform new ways to treat you for problems that are based in your genes or come from a genetic source like a virus or something. So therapeutics, molecular research. Genomics is, again, highly useful area, more medical and biotech. and it gets lumped in with innovation above it. But really, the connection here is both can apply supercomputing and highly intensive computer efforts and equipment, scientific equipment for their innovation. So genomics is overlapping a little bit, but in general, it's its own thing. That's why we broke it out. Fintech. All right. Okay. Of course, this includes a lot of different stuff. Blockchain is thrown in there, whether you like it or not. The blockchain behind the cyber cryptocurrencies is a player. It is driving a lot of chip demand and cloud demand and everything. Transaction-based and funding, your Squares, your PayPals, and your intermediaries and customer interaction. So this is, all kinds of groups. Obviously, here in Los Angeles, SoFi Stadium is owned by SoFi. We've got a massive transformation just in marketing out here, with crypto.com and SoFi Stadium. Just fintech is a real thing. And it's going to be embedded in major banks, and it's going to be embedded in their customers, and it's going to be embedded in a lot of different companies. So then we get to robotics. Robotics, again, a very interesting area. 3D printing is obviously, and building and constructing is already well in its later stages. We have a lot of things that are happening that are very interesting. Autonomous transportation, free self-driving, full self-driving is happening, and it's going to keep happening. An energy story, that's the batteries. So you add up this area and we call it robotics. And then finally, we'll get to space exploration. Obviously, we all know about Bezos and Musk and the NASA and all the other groups outside the United States pushing aerospace, orbital and suborbital launch vehicles, and the enabling technologies that surround them. So this is what we're calling emerging technologies. Emerging is a word that means it's got a long ways to go, but these things have emerged really over the last 6 or 8 years, I would say. All right, so the Invesco Qs are the large cap story of these tech stocks. Those did stay on a roll in 2021. Now, the lady in at the party that everybody loves to talk about is Cathie Wood, and her ARKK Innovation ETF is really was the leader for many years. Started in 2014, and you can see it absolutely exploded during the pandemic. She absolutely called a massive momentum price stock run, and she wrote it up. And it ended, I want to point out, somewhere in February of 2021. She has actually been staggering all the way back down to the Invesco Q trend. So now the question is Cathie Wood's ARKK fund done trading off its sloth and excesses? I generally would tell you that going to trend is not where these things end, but it's certainly more hopeful than you might have expected now that we look at the data. And so the Invesco Qs are actually giving us a story of why the ARKK has kind of held up at its level here in the last few weeks, because it actually is matching up with the Invesco Qs. Now let's get a little further into the weeds here. First, Trust Dow Jones Internet ETF is a competitive ETF that could also be tracking this environment. And as you can see there, it's actually not doing that well. So the internet companies of those 5 areas are not actually being that attractive, and they have played out pretty much over the last year as a sideways trading environment. So this is the other thing to think about, is a lot of stocks that are not doing a lot. And we're getting a lot of negative cap carry forward on the indexes that is not disclosing this to you. But some of the internet companies, frankly, are not exciting from a stock investor perspective. Now, let's get to the final one, which is the KraneShares CSI China Internet ETF, KWEB. This is actually down dramatically since February. It's gone completely consistently with the ARKK story. Interesting, but it has continued down. Now, you can see it actually picked up speed sometime in the summer, whereas the ARKK didn't. So this is the story here of China's regulatory crackdown and their ongoing push to control the excesses they feel are emerging in these companies in their country. However, it looks like, if you want to take away that story, that we're getting at nice values here. So you can see here we've got a really interesting story of 2 leaders that are kind of tracking each other again at trend. One that has gone nowhere for a good year, and the third that's kind of seeing a value play or value trap situation. All right, so top 6 holdings of the emerging tech ETFs of Ark Investments. This is fascinating stuff. I went through pretty much all these 10 tickers. First thing to note about Cathie Wood's ETFs is they all, about half the portfolio weight is carried in 10 stocks. So it's kind of not a mystery what she's putting in. And I really do recommend anybody who's looking into these ETFs to look into these 10 stocks. You can't look into it all, probably don't need to. These are the dominant stories. ARKK, once you look into it, largely benefited from the Tesla run up because it was its largest holding. But you get into some of the other players here, all the way down this list: Roku, Teladoc, Zoom, Coin, UI, Spotify, which is music, Twilio, which is cloud communications, Exact Sciences, and Path. These companies, frankly, a lot of them don't make any money, and they're not very attractive stocks. They've been trading down for quite some time. ARKW, which is the next generation internet, curious bunch of stuff in here, guys. It's really, I really have my struggles with understanding, why you stick, right, for example, Coinbase with Roku and Zoom and Twitter, Spotify. I mean, these are, I get it's the next generation internet, but it's all over the place in terms of its coherence. Same is true, frankly, for ARKF. I found, putting in, crypto with some of Teladoc, for example, Robinhood. I mean, Robinhood makes some sense, but why on earth put Teladoc into a fintech area? It makes absolutely no sense to me. SEE is sealed air. This is packaging. Strange stuff in here, people. Be careful with not looking into things. ARKQ, Autonomous Tech and Robotics. I really thought I would like this. There's some really interesting stories here. But again, I'm kind of confused. KMTUY is a tractor. Is Komatsu in Japan. Deere is John Deere. 3D is a 3D company. That's important. Iridium satellites. Kratos is a defense stock. And again, Tesla, 10% of the holdings. So again, very hard for me to see how all of this holds together. It's really more diverse than you might realize. ARKG, here again, this is supposed to be genomics, and you have Teladoc. Teladoc has nothing to do with genomics as far as it's online doctoring. I went through this whole list of all these groups, and they're very speculative, most of them. The one that stuck out was not speculative, was kind of interesting. Vertex, but everything else was kind of a curious thing. I mean, I get the idea that these are groundbreaking technologies, but the truth of the matter is the technologies are groundbreaking, but the winners, the benchmarks that will succeed in those areas, far too early to pick them. And she's doing that. So ARK-X, I think, again, strange stuff. I mean, you're putting, Komatsu in space exploration. I mean, I'm sure it is a conglomerate in Japan. Maybe they do have equipment like this stuff, but it's very odd to have some of this stuff in here. So be very careful with the liberal mission creep going on with the ARKK funds. All right, so let's get a little further down here into some of the outperformers in some of the smaller ETFs you may not know about, like, for example, Amplified Transformational Data Sharing, ticker BLOK, which is that blue line that's moving up and down over this last year. Then we've got iShares Evolve US Financials, that black line. Then we've got iShares Evolve US Technology, which is that green line. And then finally, we've got the iShares, or just as old spider. So here, again, you can see the volatility of the transformational data sharing names. And then also everything else, frankly, didn't buy you much that you couldn't have got out of the S&P 500. So that's worth knowing. And again, looking down through what are these top tech ETFs by assets under management is very notable. The ARK funds, like I said, started the whole thing in 2014, October 31st, 2014. They have a high expense ratio, by the way, 75 basis points, and they are assets under management 17 billion. So they're a huge player in this, basically half of it. But the Dow Jones Internet we talked about hasn't done all that well. China Internet's way down at 7 billion. And then we get the Ark Next Generation Internet, which is 4 billion. So there's now 21 billion with Cathie Woods. And then the Qs are only 4 billion. So it's strange to me to not have just played the Qs here, QQQM, which is the market weight, and stayed away from all this stuff. But people really have bought that momentum of 2020 with her funds, and she's a big part of the story. All right, so let's take a look at tech ETF issuance. A lot of issuance in 2021, but not a lot of assets under management of those groups. I mean, it really was a story of 2020. You can see it was less issuance, but double the amount of assets under management. So the bubble probably over its limit. And then again, look all the way down to 2014, the 4 issues that started it all. Cathie Wood, 24 billion there, 9 billion the year before. Basically, this is carry on stuff. Hundreds, dozens of little funds that are trying to catch up to Cathie Wood's 24 billion. On the other side, you can look at it's now 26 billion for Ark. And you can see everybody else is kind of down the list. But there's some big names in there. BMO, Goldman, First Trust, Direction, BlackRock, Roundhill, Invesco. These are big names. So anyways, keep in mind that Ark, at the end of the day, was why I talked about it a lot, is really the primary marketing vehicle for all this stuff. And the rest of these groups might actually be safer and more consistently less volatile, and frankly track her fund over the longer term anyways. So keep this in mind. Those are the broad thematics. To keep these in mind, we can go through all these, but the basic point here is broad thematics, and the China Internet and global Internet are kind of the big players, and everything else has really not gotten big. For example, global Fintech, 2.3 billion, not that big. And global blockchain is about 2 billion. So these things are pretty small. All right, the newbies. Let's talk about one thing here. I don't want to get too far into this slide, but these newbie funds have forward 12-month PEs here. I'm talking about Murray, Invesco, Murray Asset Global, all these top funds, bots, these numbers in the top. Look over on their PE on the one side, and you can see we're looking at anywhere from 50 to 112 PEs. I mean, these are extremely rich valuations. Extremely rich. So how do we compare this versus like the Q? So go to the next block, which is Invesco QQQM or QQJ. These things do, on a different measure, price to book value. Those funds, the big ones, are 13 times book value. These Murray Asset Global is almost triple that. So there is a very worrisome bubble in these smaller funds, but you got to remember they also don't have that much assets under management. So these little areas that have been filling up with these really speculative companies aren't likely to tip everything over, because unless Cathie Wood starts playing around with them, which she may well do, but generally speaking, that's not the case here. All right, so the PEG ratios for Invesco NASDAQ Next Generation QQQJ went from 1.5 in 2017, that's the top on your far right, all the way to 2.35 in 2021. PEG ratio, generally anything over 2 is somewhat overvalued. So you can see it actually started all the way through 2017, 18, and 19 as being pretty decent values. It was in 2020 that it really got out of control. And actually now it's less worrisome than you might think because of the reductions, but you can also argue another 0.6 have to come out of this, or another 15 or 20%. So to get to just 2, if Cathie was getting tracked into the Qs again, she's got another 20% to go. The QQQM, a little better story there, maybe 5 or 10%. You can see back in 2017, the QQQM was 1.93, and now it's 2.14. So it's moved up 10% in valuation, not as much. So the good story here is if Cathie was going to get back to tracking the Qs, maybe, this is a way out that's not so painful for everybody. All right, so this is just going back into our research system at Zacks and asking us to look at the earnings estimates going over the last year, how they emerge for the Invesco NASDAQ 100 QQQM. So this is QQQM charts for the first half and the second half. And what I can show you here is what you should understand is by July, 7/31/21, to 8/31/21, you can see that basically this whole group stopped getting a real surge in profits and earnings. So there really was a story that got that bubble moving through July of last year, but it's actually played out sideways since then. So the big come out forward out of the vaccination boom has played out. And that's something to keep in mind here. Is the other thing that's not happening anymore is there's no estimate revisions helping this entire setting move forward. All right, so price and earnings ratios, these are the cues looking at the various different innovative ETFs. All I want to point out here is that in general, they pretty much have stayed on trends. The bottom one shows you next gen struggles. That's the one I want to point out to you, is that you get into the internet struggles in 19 and 20. That one had a big plunge from the shutdowns, but the more important one here is the next generation ETFs. Those are the categories that actually did not accelerate profits. They actually went down. So this is to be what's concerning here is the bottom one, which is why have earning estimates actually gone almost to zero for earnings, and the stocks have held up. But as you can see now on that chart particularly, it has gone sideways. So it's kind of betting on a recovery. You can see some of that recovery has taken place, but it's not seen anything more than just a recovery to its previous high. So not a lot of optimism here for earnings to accelerate this process, but there's modest stories here that should keep you comfortable. All right, so that's it for me, and I want to thank you all for joining my first Tech Talk, and I hope you liked it. And we will hopefully do this again someday, and we will find our way back to the story of this market. So once again, this is the 2022 strategy set from John Blanket Zacks, Chief Equity Strategist and Economist. I will have our marketing team give you all kinds of directions on how to get on board with our efforts, sign up for our efforts, and put in your contact information so that we can get a hold of you and help you learn more from us about our services. Obviously, that's what we're all about here, is trying to provide information at a high level to make these decisions. And these talks here are about that. So please feel free to get on with contacting us and assisting us in making it happen, that we can reach out to you and improve the way you understand this market, because I think we can add a lot of insights that are really valuable to you as a customer. So keep that in mind, and that is going to wrap it up for my first session.